Welcome back, class, to this second segment of Chapter 10. We're going to talk for a few minutes about types of money. And the authors within the textbook really define money in basically two types. And they talk about commodity money. And they define it as money that has value apart from its use as money. Think about the early United States, furs, tobacco, bourbon, gold, silver, shells, turquoise, different forms of money that was used in barter. And it not only was used in barter as a medium of exchange, but it also had an intrinsic value. And so economists talk about value in use and value in exchange. So gold, it's got a value in exchange, may not be as liquid as you would like for it to be, but it's got a value in exchange. But it's also got a value in use. You can use gold for multiple uses. Use silver, platinum. Even go back to furs and tobacco. Those are all examples of mediums of exchange used as money. So they had a value in exchange. They also had an intrinsic value or a value in use. And the supply of money can vary significantly. Depends on how many consumers are putting money under their mattresses, how many consumers are saving, how many consumers are actually spending money. Supply and demand is difficult to manage. The Fed and policymakers have a really difficult time responding and to the fluctuations of money. And if they can't respond to the fluctuations, it's really difficult for them to manage a money supply. It's costly to use, difficult to evaluate, quantity and quality. And I guess they talked, and I can't remember the date that they talked about, but they used the term clipping. And it's where individuals used to shave the edges off of coins. So they would take a coin, shave some of the edges off, and use it in other ways, and still use that coin as a medium of exchange. And individuals would accept it for the value that it's at least theoretically possessed. And then the government started milling the edges. So if you take a look at a coin and look at the edges, it's got that mill work around the edges, so you can tell whether it's been shaved or not. If you happen to be living in the early United States, especially maybe in the 1700s, they would actually took coins and cut them. They would take a coin, and I want to say they cut them into eighths. So a coin had, you could take it and cut it into 8 separate pieces. It hadn't been that long ago that I was in Williamsburg and listening to one of the docents as you walk down the main drag, and they were talking about taking coins and cutting them into, again, I think it was eighths, but evidently fairly common practice in the early days of the United States. Gresham's law says bad money drives good money out of circulation. And that goes back to the clipping. Bad money drives good out of circulation. It becomes a situation where buyers and sellers don't really trust each other. Metallic coins are socially inefficient, limits the use of society's limited resources. Now we're talking about opportunity, going back to opportunity cost. Remember, the 3 pillars of economic thought: opportunity cost, decisions at the margin, marginal decision rule, and then self-interest or optimization. So metallic money, think what it's like to, you can carry a dollar bill in your pocket, or you can carry 100 pennies. You can carry $100 bill, or you can carry that level would be in your pocket, but you could carry the number of pennies that it takes to make up $100. So that's why sometimes metallic money, that the authors consider it socially inefficient for transaction as a medium of exchange. Must be commonly accepted in exchange. And that's the good thing about money. For the majority of the individuals, and we'll just take the United States, for the majority of individuals in the United States, they will accept money. Buyers and sellers both accept money. Most individuals anymore, though, it's really difficult to carry money, especially in the younger generations, especially, I mean, we'll just take college students. How many college students actually carry money in their pocket? My guess is the majority of them have a debit card or have a credit card. And that's what they're going to use for the majority of their transactions, debits or credit cards. During COVID, I'm traveling, and we happened to be moving from Buffalo to Atlanta during the COVID fiasco. And there were times that you would stop at a Love's or a Pilot or a Flying J to get gas and to refuel the rental truck we were using. And you would go in, and if you went to pay for cash, there was a big sign on the by the teller that said, "We do not have change." If you asked the teller, which meant didn't have change, she said, "Well, if somebody gave me a $20 bill and the gas, the price of that they'd filled up the car was $19 and a quarter, I couldn't give them change. I had a few bills, but she said I didn't have any coins to use as change." So, metallic coins, currency, money in the medium of exchange or the transaction space now, it's almost becoming obsolete. And then the authors talk about fiat money, and it's money that some authority, generally a government, has ordered to be accepted as a medium of exchange. European Union, driven by the euro. India has their own currency. Russia has their own currency. United States has theirs. England has, the pound. So governments have mandated that a given type of currency will be used as a medium of exchange. That's what's referred to as fiat, F-I-A-T, fiat money. Currency is defined in the text as paper money and coins. And it also, translates to fiat money. Very little use other than money. What's a dollar bill that you got in your pocket good for other than the medium of exchange? Doesn't have any real intrinsic value. Now, if you had a gold bar in your pocket, there's a lot of intrinsic value. I think the spot price of gold is probably around $2,000 an ounce. So a lot of intrinsic value in that gold bar, but hard to use as a medium of exchange. Not a lot of liquidity there. Again, you're going to have to find some way to translate or transition or transform, transfer, whichever verb you want. How are you going to take that gold bar and turn it into currency, either paper currency or coins that you can use as a medium of exchange? And if you look, talking about intrinsic value, that's what separates a lot of mediums of exchange. Does it have intrinsic value or it doesn't have intrinsic value? Now, if you look at the dollar, if you've got that dollar and you pull that note up, it says this note is legal tender for all debts, public and private. The United States government has mandated that you can use a dollar bill or a $5 bill or 10 or 20, whatever you've got in your billfold or your purse. You can use that as a medium of exchange. It's legal tender for all debts, public and private. So you've got the you're going to move now from commodity money to checkable deposits. Checkable deposits, balances in checking accounts, not really any intrinsic value. You can use it as a medium of exchange, as the government's mandated. Legal tender for all debts, public and private. But you can use the medium of exchange. You can use it, checkable deposits. You can write a check on it. You can, if you're traveling, used to everybody that went, outside the continental United States, raced to the bank and grabbed a bunch of traveler checks. So traveler's checks, written as, checkable deposits. Again, got your debit card. Most students are, probably living off their debit cards. You may have a few with credit cards, but I'm guessing the majority of students, if they're not using cash, hardly anybody carries a check around anymore. Very few people even pay their bills with check. Most of it is some kind of electronic transmission. And, occasionally, and I find it odd, but occasionally you will see some businesses, let's say, that won't accept a credit card. They'll take cash or check. I can remember being in Philadelphia and being in the Italian district, and went to one of the better Italian restaurants. And when it came time to pay the bill, I just took my credit card out, and laid it on the bill that the waiter provided, and he said, "We don't take credit cards." I looked at him, kind of an odd expression. He says, and there was a big sign on the wall that I just hadn't noticed that said cash or personal checks. And I'm thinking, I was with a group and I didn't have enough cash to cover it. Fortunately, my wife was with me, and in her purse, she happened to have our personal checkbook. And, she took and said, "This personal check?" And he said, "Absolutely." He took, she wrote him a personal check. He didn't even ask to see driver's license. He just took the check, went up, cashed it out. One of the other individuals at the table took and paid the tip in cash, and we walked out the door. It depends on the business, but as long as it's a checkable deposit, there is some level of security there, or some rationale that there's going to be money there to take care of, again, the debts, public and private, in your checkable deposit. The checkable deposit is the money. And when you write a check, it's a written order to a bank to transfer ownership to somebody else's checkable deposit. So it's flowing from one bank to the other in a checkable deposit, unless the individual tries to cash the check, and at that point, the bank will just hand the individual money. Check and debit cards facilitate transactions. Think how easy it is to pay for anything with I'm not going to say a check, but with a debit card. Think how easy it is to pay anything with a credit card. And then the authors talk for a few minutes about measuring money. And money supply, it's a total quantity of money in the economy at any given time. And most economists look at that as the stock of money, or the money stock. Money supply affects economic activity. Checkable deposits are financial assets denominated in dollars. And just think about your bank. When you get your, let's say, I don't know whether you even get a written monthly statement anymore or not. I don't, but if you do, you can look at that, and it'll have your balance at the end of that time period. And the balance will be quoted in dollars. So you can get on the internet and check your bank account, and it's going to be quoted to you in dollars. M1, it's the narrowest of the Fed's money supply definitions that includes in currency and circulation, checkable deposits, and traveler's checks. Again, they are counting traveler's checks in with the checkable deposits, and that's because it is a medium of exchange, and it is as good as a checkable deposit. M2, it's a broader measure of the money supply than M1. It includes M1 and other deposits. M2 includes savings accounts, small CDs, personal money market accounts, money market or mutual funds. So it takes M1, which are your checkable deposits and traveler's checks, and adds your savings and mutual funds and small CDs to it. Liquidity, it's the ease in which an asset can be converted into currency. Checkable deposit, traveler's check, debit card, to some extent credit card, that can be converted into money. Not a lot of intrinsic value to it. Matter of fact, no intrinsic value to it, but you can convert it with ease into money as a medium of exchange. You can use it as a medium of exchange without actually having money. So it takes the place of money as a medium of exchange because it's driven by the checkable deposits. Gold, if you were using gold as a medium of exchange, it's got a lot of intrinsic value. A couple of $1,000 an ounce, I think, is the last spot price I saw. But not very liquid. And unless you've got somebody that's willing to take that little gold bar, that little 1 ounce bar, maybe you went to Costco and bought you a little 1 ounce bar. And if you can find somebody that's willing to take it and in exchange for a debt, then it's probably got a lot of liquidity, at least to you. May not have that same liquidity to the person taking it to offset the debt that you owe. And again, M1 and M2, M1 is a highly, it's a more liquid supply of money than M2 is, because M2 has some CDs and some savings and some mutual funds rolled into it, and they're not nearly as liquid as the checkable accounts or checkable deposits. Which measure of money, M1 or M2, is the most closely related to real GDP and the price level? So that's what, for the most part, it's probably what economists struggle over. The banking system, and then they spend a few minutes talking about the banking system. They talk about financial intermediaries, and then they jump into the Federal Reserve. Only has partial control over the money supply. Banks and other financial intermediaries, and here's where they start going through the authors start going through. I'm going to say some almost accounting terminology, and I think they actually apologize in the text about going back to your basic accounting classes, but there may be some individuals in this macro class, or there may be not just this macro class, but macro classes in general that might not have had an accounting class. So they talk about financial intermediary. It's an institution that amasses funds from one group and makes them available to another. Banks, pension funds, insurance companies, financial intermediaries. A bank accepts deposits. You can go and deposit either you can go into a bank, which hardly anybody does anymore, or you can have it direct deposited from your paycheck into your bank account, either into your savings account or your checking account. So bank accepts deposits. Depositors are allowed to withdraw their deposits on short notice. You've got money in your checking account, you can go to Publix, you can go to Kroger's, you can go out to a restaurant, whip out your debit card and swipe that thing, and you're going to pay. You can pay the bill, you can pay your grocery bill, the bill at the restaurant, and you have access. As long as you have money in that checkable deposit, you can have immediate access to it. And then banks also make loans to borrowers. And then the authors start to move into bank finance and what they call a fractional reserve system. And then this is where they start moving into, they talk about a balance sheet. It's a financial statement showing assets, liabilities, and net worth. And assets are basically anything of value. So if you think about your assets as a undergraduate student, I can remember being an undergraduate student. My assets consisted of what money I had in the bank, and a car. Didn't have much else. I mean, that's all things that lending institutions are going to look at. They're not going to worry about the amount of clothes you have or anything like that. So you're talking about assets of anything of value, and not so much of value to you, but anything of value to somebody else, especially an institution if you go in and try to apply for a loan. And they talk about liabilities or obligations to other parties. Your liabilities as an undergraduate may be student loans, maybe you've got a auto loan, you've got rent, you've got a lot of liabilities, you've got credit card debt. And so liabilities, you're talking about, so you've got assets, what's a value, you've got liabilities, which you owe, and then your net worth, it's assets minus liabilities. can be called owner's equity if you're in the world of business. So, it's kind of equity you as the owner of a business. Can be called capital accounts if you're in the banking industry. But for individuals that especially aren't either in the banking industry or maybe if you're an entrepreneur, you're going to be the owner of a small business, and it might be considered your owner's equity. But for most of us, your net worth is basically your assets minus your liabilities. And from an accounting perspective, if you think about, if you've ever seen a balance sheet, you've got over on the left-hand side, you've got your assets. Over here on the right-hand side, you've got your liabilities. And then also on that right-hand side, down at the bottom, you've got your net worth. So assets minus liabilities gets you to your net worth. And if you own a business, let's say a bank, or you own a business on the left side, you can kind of, if you're a bank, you're looking at the bank's use of funds. Your bank has some capital stock. They've got maybe a building. They've got some computers. They've got some office furniture, and they've got the loans it made, the loans that they have made out to borrowers. On the right-hand side of the bank, of that balance sheet, they've got sources of funds, things borrowed, your deposits, my deposits, owner's capital, and so the owner's capital ends up down here at the net worth. So again, if you look at, depends on what market economy or what industry or what business you're in, your balance sheet may look a little different, but it's still going to be structured. Assets on the left-hand side, liabilities on the right-hand side, and then down on the bottom of the right-hand side, you're going to have a net worth number. Reserves, from a I guess a banking perspective, reserves, banks' assets held in cash in vaults and in deposits with the Federal Reserve. So the Federal Reserve has bank deposits and it has loans to banks. That's kind of what it's doing I don't want to say on a daily basis, but that's one of the functions. It's, holding stuff, reserves and vaults at the Fed, and they're also making loans to banks. And that's why the banking industry is considered a fractional reserve banking system in which banks hold a fraction of their deposits as reserves. So the bank always has to have a certain percentage of their deposits held in reserves in case there's a run on the bank, because again, remember what we said, depositors of the checkable deposit. So if you have a checkable deposit, you're supposed to have immediate access to that checkable deposit. And with that, we're going to stop for a few minutes, and when we come back, we're going to talk about money creation.